come down with a great moderation. We've enjoyed the last 7 years. Where are we now in that continuum when we observe odd things? Mathematically, I would say, folks, we need some math on radio. We've got a log chart with a lot of curves like Indonesian rupiah, Brazilian real, and other challenges within the United States. Ray Dalio, where are we right now within that equilibria?
The United States is in the midpoint of its short-term debt cycle, capacity utilization, GDP gap, and so as a result, we're talking about whether the Fed should tighten or not. That's what central banks do in the middle of it. And we're near the end of a long-term debt cycle, because that cycle of being able to raise, you have interest rates going to zero. You have spreads that have come down. So those spreads that have come down means that asset prices have gone up. In other words, so now the expected return of asset classes are all very low. Cash, we know that bonds are going to 2.25%. So you know that you're going to get for the next 10 years 2.25% on your bonds. The equity price premiums look like 3.5% or 4% on that. So all of the asset classes now are aligned in normal risk premiums, that kind of thing. That's why if interest rates rise faster than is discounted in the markets, those markets are discounted.
Well, critically, and for this room, which is, I might point out, for those of you worldwide on television and radio, is an exceptionally competent group of Bloomberg Terminal users and cohorts in crime with Ray Dalio in the alternative investment funds business. With that said, Ray, within the framework of your machine, do you presume a jump condition as central banks come out of this, or can they manage it with smooth vectors and smooth glide paths?
I don't believe that they can raise rates faster than is discounted in the curve for a large part, because that interest rate curve, in other words, the rate at which it's discounted to rise, which is built into the curve, is built into all asset prices. And if you raise them much more than is discounted in the curve, I think that's going to cause asset prices to go down, because all things being equal, all assets sell at the present value of discounted cash flow that we look at that. And all of them are subject to the same discount rate. They all have that built into their structure. So if you raise rates that's faster than is discounted in the curve now, all things being equal, that produces a downward pressure on rates. And that's a dangerous situation, because the capacity of the central banks to ease has not been less in our lifetime. So we have a very limited capacity of central banks to be effective in easing monetary policy.
Well, that raises the question of what is discounted now. The Fed is talking about 25 basis points to start and then being on hold for a while, and no other central bank is talking about raising. Very asynchronous world.
Right. So, well, you know what the curve is. And so if they raise it by 25 basis points, it's a little less than, it's a little more than discounted, and we're just really tweaking. So very, very small rise in rates. The issue is that the dollar is the world's currency, and the rest of the world would need an easier monetary policy. When I say the world's currency, I mean there's a lot of dollar-denominated debt. So the Federal Reserve has a responsibility, both as the U.S. central bank and the world central bank,